What is up, YouTube? This is the Working Investor. This is an interesting video because this is the video that I'm going to tell you why I dumped all my inverse funds. Got rid of Crash, got rid of Fiat, got rid of dips. I have a subscriber that asks me about YQQQ, and this is the same reason why I'm not into YQQQ. It's not just because these underlyings are really beaten down. I mean, if you go to CK Alpha and you go to total returns, for Fiat, since they came out, they're down 40%, 40.88% total return. Forget about price return. I'm talking about even if you factor in the dividends for Fiat, right? And if you go to dips, if you go to total return since inception of the fund, it's down 24.89%. And if you go to the Crash since inception, it's down 43.29%. So it's not, I made sure that it's not because of the sentiment. You know, you don't want to feel like, oh, the sunk cost fallacy that it's down and, you know, you don't want to get out of it. It was because I have specific reasons why I got into these funds. They were new funds. I wanted to see how they go. It was an experiment. And the reasons I'm going to explain to you why I got into this fund, for me personally, did not work out. It does not match my thesis. Everything I say is not financial advice. This is my personal journey, my personal understanding, and that I'm going to be sharing with you. But you need to make your own decisions. Otherwise, you could find yourself down possibly 43.29%. So there are three main reasons why I got out of these funds, and I'm going to break down the pieces of these reasons. So number one, I got into these funds because I wanted to create something called a covered strangle. And the reason why I like covered strangle is because in a nutshell, you get double the premium in a covered strangle. And I'm going to explain to you why it doesn't match the way I like to do a covered strangle. Another reason I got out of these funds is because, of course, I know I mentioned it. I understood this. It says it in the prospectus. I used it kind of as a hedge, but it's, even though the prospectus says you should not use it as a hedge, I still did. And it doesn't do the hedge that I would like it to do if the market would go reverse direction. Another reason is because the market most of the time is up into the... Historically speaking, the market is down, let's say, over the past 94 years, let's say around 21% of the time. So 21% of the time. That means about 78% of the time, historically, the market has been up. Past performance is not indicative of future gains, and the future can always surprise us. Nobody has a crystal ball, but the past is the best educated guess to try to guess what the market's going to do in the future over the long run. And that's what I use, even though you shouldn't really use it. I rather hang my hat as a long-term buy and hold, not a short-term type of trade for something that goes up and to the right. So those are my three main themes. So let me start off with the covered strangle theme. So the covered strangle is a strategy that works mostly best for a neutral market or a stock that trades sideways in neutral, because it's a neutral. You get a max profit when a stock trades within a range. So let's say, for example, IWM, which is the Russell 2000, which I actually have done myself, covered strangles in this underlier. So let's say you own 100 shares of the Russell 2000, which is IWM, and you want to sell a call because you want to get income, but you also don't mind building up your position, and you can collect at the same time double the premium. So let's go to trade options. Let's go to November 29th. And let's say you bought the shares, 100 shares at the market price of $231.16. So you want to sell, let's say I want to do a 16 delta call, 16 delta put. So you see here on the left, it says delta 0.1639. So let's say I will collect 60 cents times 100 shares per contract. So it's $60. And I'm willing to get rid of my 100 shares that I paid $231.16. I'm willing to get rid of it for a profit, but not an infinite profit, but cap my profit to $238. So you're only going to have about $7 or $700 in profit. So $700 in profit. I've capped my upside. I got paid $60. Now let's go to sell put. Same expiration date. We're going to go down to the put side, and we're looking for a 16 delta put. You don't have to do 16 delta put. You could do 30, however you want to do it. I like to do a standard deviation out of the money. So the closest one I see is a 1.1523 put. So that's the 223 put. I would collect $64. And the contract is that I will be assigned the shares. If the price goes down from 231 to 223, at any point it breaks this put, I may be assigned 100 shares, even though it goes further down. So if I'm interested in buying it at this price, I'm happy to buy this at this price, I could build something called a covered strangle. So covered strangle, instead of making $60 in profit, I'm making $124 in profit. And it does well. I get max profit if it stays between the strikes of 223 to 238, right? But once it goes below this strike and it goes below the money I received, the $1.24, then I start, missing out relative to the market. It could start being as a loss or a relative, loss compared to the market. And the reason why I like doing it on the Russell is because they tend to trade for the most time kind of sideways, but they have a very slow skew up, and then once in a while they jump up, and then they eventually, they tend to trade sideways a lot of the time. They do have their fluctuations, but they kind of trade within a range. Some underliers, like for example Tesla, maybe at certain periods of time they do trade within a range. Like they seem like to be kind of choppy here, trading sideways between this period of time, but then jumps right up, kind of, it finds its new holding, its footing, and then jumps back up again. But right now it seems to be going extremely up and to the right? So I don't want, and they do have their crazy volatility, hence they have amazing premium. But overall, I don't want to bet against Tesla. If I bet against Tesla in the long run since inception, I would not look really good. A good example would be something called the SQQQ. So the SQQQ is a triple leverage inverse short NASDAQ, the Qs. And as you know, the NASDAQ has been up and up over a lot of time. But if I put all my money into SQQQ as a long-term hold, not for short periods of time, this is what my P&L will look like. Negative 0.99.99%. That would be a very, very not favorable type of idea. I don't want to bet against the market. I don't want to bet against the highest movers of the market. I don't think it would fare me very well. Maybe somebody who wants to play bets against the market, not financial advice, maybe for a short period of time, a defined period of time where they think the market's going to go through a crash or something, maybe for a specified period of time, it may be a good move. But I don't know if for a long-term buy and hold, if that's my style. If I could keep a long-term buy and hold, it won't fare me well. Another thing with the yield max is that when you do your own covered strangle on the same underlying, you could build up positions. You could leg in, a leg out, and put on covered strangles. But that's if you have one underlying and you're doing multiple options on them. But when you have two separate ETFs, it's you're putting double the capital to hold double the amount of positions. You're not really legging in, legging out. It's kind of, even though they're exposed to the same underlying, it's not the same. Another thing is that in order to get a lot of profit, Yield Max does close to the money shorts. So because they write everything close to the money, I may not want to write it so close to the money in certain times because I want to pick a direction. I want to skew that cover strangle. So that's why it's not a good idea for me. Another thing is now we're going to the second reason. The second reason I mentioned was the downside protection. Now the synthetic covered puts, aka the inverse funds, crash, fiat, dips, YQQQ, they collect income because they're giving you dividends because they're collecting premium because they're writing short puts. And they're writing short puts, that means that they're limiting your downside protection, because theoretically if the market went down, you're only protected up until this line where they wrote their short put. So you may have some appreciation in the inverse fund up until the strike of the put, unless, of course, the fund managers are able to manage the fund further. But there's only so much you can do. Maybe they can mitigate some more of the losses, but it may not help you all the way as a pure 100, pure hedge completely. So you may miss on all this part of hedging over here. So that could be a problem. And then another problem I understand with the synthetic cover call strategy, and I mentioned in one of my other videos, is the whipsaw. Like if the market goes really fast down, right, and you write cover calls, because normally if the market is kind of chopping up and down, let's say the market goes up and this red line is that's your cover call, that's your strike price. So you're missing out in this area of the upside. You missed out some, but you captured some of the upside. But then the market comes back down. You have opportunity to capture more of the upside. You're missing, but it's up and down, up and down. So you always have little opportunities. But when you have this violent, whipsaw down, and then you write a short call, you're missing out on all this upside you're missing out on over here. So that could be very, very scary and frightening. So there are other ways where somebody could try to mitigate these risks. Some people, what they do is they use their dividends. I'm not telling you to do this, but I've seen people do this. They take the dividends and they actually buy the actual underlying. So now they have some of their position capped and some of their position has no cap to the upside. Or one could decide to buy the underlying when the market has a crash, use the dividends to buy some more shares, but maybe also some more shares of the actual underlying. There's other ways somebody can mitigate Another thing that is just so, so much that I can't even talk. I'm so excited. What I'm trying to say is the cover call strategy or the synthetic cover call strategy overall, besides the whipsaw, is a neutral, bearish to slightly bullish type of strategy. They will outperform the market if the market would go sideways, down, or slightly up. So that in itself is a hedge against the downside. Let me explain, except for the whipsaw. So let me explain. So let's say you go to trade options on the S&P 500. Let's say you own 100 shares of the S&P 500. Let's say you go 10 days out, right? So it's trading at $590.94. So 100 shares would be a little over $59,000. Let's say you got $59,000 in the S&P 500. So if the S&P 500, if your entire fortune is in the S&P 500, your P&L will fluctuate with whatever the S&P 500 does. They do have a little dividend, so you may have a little extra total return, but more or less you'd pretty much be moving up and down. So if you go down with it. There's no cushion, nothing. But if you sell covered calls and the market is going down or sideways, you actually may have a little cushion. Let's go to sell call. So you see it's trading at 590.98. Let's go to a 0.16 delta. And so that is 602. So you're giving yourself room of around $12 that you can capture on the upside. So if the market stays where it's at, right, or goes down, right, it's going down, or goes up a little bit, up to $12 of upside, you are $95.97. You're $96 richer than the market. Whatever happens to the S&P 500, you still have your $96 cushion. And let's say you repeat this trade over and over and over every 10 days. Every 10 days, you're making $96 every 10 days. Of course, it'll fluctuate. But by writing these cover calls, you will outperform the market as it goes down, because your potential, if you own raw stock, your potential is that you could lose everything, right? If you paid $59,000 to buy right now 100 shares of SPY, you could lose, if it goes to zero, you lost $59,000. But every single time you get let's call it $100, every time you make $100, you now know your bottom is no longer zero. Your bottom is $100. They could, if the SPY goes down to zero, you still have $100. Nobody can take that away from you. And then every time you do that, you're increasing that bottom. So let's say eventually it'll be 1,000, 2,000, 3,000. That your bottom is higher. So you're outperforming the market in a bearish, neutral, or slightly bullish market. So that in itself is a hedge. The strategy in itself is a hedge, except for the whipsaw, which we have to figure out different ways to mitigate. I've seen another strategy people use to mitigate. Again, not financial advice, just something I've seen is, let's say you buy 1,000 shares, right? Let's say you buy 1,000 shares of underlying, right? Instead of selling covered calls of all your shares, especially if the market went down, crashed, and you don't want to cap out all your shares, their upside potential, because let's say that you're thinking about maybe mean reversion. So let's say you only do 5 covered calls. These are CC covered calls. So you're only gonna have half your shares capped, and the rest of the half, you're just going to hang on to it for a bit and see what the market does. Then it's almost like a ratio spread, because in a ratio spread, you're capping out some, but you're not capping out all. So if the market goes up again, you half your shares will have infinite gain, and half your shares are capped. So you kind of are giving yourself some protection against that. You're getting some income, you're getting a blend of some income, and you're also getting a blend of not putting yourself at risk from capping if you're worried about the market snapping right back. So that's another strategy I've seen people use. Anyway, so those are the reasons why I got out of these inverse funds. Let me know what you think. Again, I this didn't come overnight. This wasn't spur of the moment. I have been thinking about it and ruminating on this over and over again, trying to look at this from all different angles. I'm not saying that anybody holds these inverse funds are wrong. I'm not attacking anybody. This is my conclusion of it, but I guess you can argue the other way as well. I'm by no means attacking anybody, or I don't mean to insult anybody or anybody's intelligence and at all. And let me know what you think about the inverse funds. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful trading week.